The trading gospel, etched into the first page of every textbook, is a simple one. Follow the volume. High volume on a breakout, they claim, is the ultimate confirmation, a green light from the market itself. But on October 19th, at precisely 10:30 a.m., this gospel became a lie. The chart displayed a textbook bullish breakout. Price action shattered a key resistance level. Accompanying this move was the single largest spike of buying volume in 3 weeks. For thousands of retail traders, this was an undeniable signal, an invitation to join the herd. Yet, within the next 90 minutes, the price collapsed, erasing every single gain and trapping an entire legion of buyers in a catastrophic reversal. The volume spike was not confirmation. It was the closing of a trap. It was the echo of an institutional entity distributing its massive position to a euphoric, unsuspecting public. This event is not an anomaly. It is a feature of the market's architecture. The standard volume indicator, the tool traders are taught to trust implicitly, is fundamentally broken. It tells a story, but it omits the most critical character, the institution. To understand why this deception works, one must first abandon the retail lens and adopt the perspective of the machine. The institutions, the algorithmic trading desks, the multi-billion-dollar funds, they do not see the market in terms of simple bars and candles. They see it through a different metric, a hidden axis of value that dictates their every action. They operate on a plane of existence, where the final price of a single trade is less important than the average price of 10 million shares. Their success is not measured by catching a breakout, but by their efficiency relative to this value metric. The standard volume bar tells you how much was traded. It fails to answer the critical question: at what value was the war for liquidity truly won? The key to decoding their footprint, to separating genuine strength from calculated distribution, is not found in counting the number of shares. It is found by tracking the market's true center of gravity, a concept known as the volume-weighted average price, or VWAP. But the real power of this indicator is hidden in a parameter most traders completely ignore, a statistical key that unlocks the institutional playbook. The volume-weighted average price is not merely a moving average. To treat it as such is a fundamental error in logic. A simple moving average is democratic. It treats every closing price with equal importance. VWAP is a meritocracy. It assigns weight based on volume. A price level where 1 million shares traded has 1,000 times more influence on the VWAP than a level where only 1,000 shares traded. This calculation creates a dynamic benchmark, the institutional mean. It is the line against which multi-billion-dollar execution algorithms are judged. An algorithm tasked with buying 1 million shares of a security is deemed successful if its average entry price is below the session's VWAP. Conversely, a selling algorithm wins if its average exit is above the VWAP. For these colossal entities, the market is a simple, binary game. Are we getting a good price or a bad price relative to this line? This creates a powerful self-fulfilling prophecy. When price dips significantly below VWAP, it is perceived as on sale by large buyers. This triggers accumulation algorithms, which provide a floor of support. When price rockets far above VWAP, it is seen as expensive or overvalued for the session. This is an opportune moment for institutions to distribute shares, to sell their positions to eager breakout traders. This selling pressure acts as a ceiling, pushing price back down. VWAP is the anchor, the financial equilibrium for the entire trading day. Observing price's reaction to the VWAP line provides the first layer of our analytical model. It allows us to re-examine the failed breakout from earlier. The initial price spike occurred far above the established VWAP. The massive volume surge was not retail traders confirming a move. It was the institution unloading its inventory at a premium price. The volume was real, but its meaning was inverted. This understanding is a significant leap forward, transforming the trader from a passive observer into an active analyst. But it is incomplete. VWAP tells us where the center of value is, but it doesn't tell us how far is too far. It doesn't provide a quantitative framework for risk. To understand why some deviations from VWAP lead to massive reversals while others begin new trends, we must first examine the flaw in its core logic as a standalone tool. The market is a system of probabilities, not certainties. A single line, even one as powerful as VWAP, is an insufficient tool for navigating a landscape of statistical noise. To construct a robust model, we must quantify the concept of normal deviation. We must build a framework that defines what is statistically likely versus what is an extreme, an anomaly worth paying attention to. This is achieved by applying a standard statistical measure, the standard deviation. By plotting bands at 1, 2, and sometimes 3 standard deviations above and below the VWAP, we are no longer looking at a single line. We are looking at a dynamic map of statistical probability, a value channel for the trading session. Approximately 68% of all trading volume for the day will be contained within the first standard deviation bands. Roughly 95% will be contained within the second. These bands are the invisible walls of the institutional playground. They are not arbitrary lines of support and resistance. They are calculated zones of statistical extremity. When price approaches the second or third standard deviation band below VWAP, it is statistically cheap. This is the prime hunting ground for institutional accumulation. This accumulation is rarely explosive. It is methodical, patient. The institution's goal is not to spike the price, but to absorb as many shares as possible with minimal market impact. They are the silent whale, filtering liquidity from the market. A trader looking only at price would see a weak, sideways market. A trader observing through the lens of our VWAP model sees the footprint of accumulation. Conversely, a sustained push to the upper second or third deviation band signals a statistically expensive market. This is the kill zone for distribution. Here, institutions begin to offload their inventory to the public, who are often chasing the peak of emotional excitement. This is precisely what occurred in our initial case study. The breakout was not a sign of strength. It was a journey into a statistically overbought extreme. The model is now taking shape. We have moved from a deceptive single indicator raw volume to a dynamic framework of value. We can define cheap and expensive, not based on feeling, but on statistics. But one final piece of the puzzle is required. There are moments when these bands are meant to be broken. A truly powerful trend, driven by a fundamental catalyst, will not respect these boundaries. To differentiate a reversal from the start of a genuine institutional repricing event, we must analyze the character of the price action itself. The completed model synthesizes 3 distinct data points: price location relative to the VWAP bands, volume behavior at these extremes, and the subsequent price action. The synthesis of these elements is what separates noise from a high probability signal. It is the final step in decoding the institutional footprint. Consider an asset's price grinding down to the lower second deviation band. This is the first alert. The model now requires a specific volume signature. We are not looking for a massive spike. Instead, the ideal signal is a sustained increase in volume without a corresponding drop in price. This is called absorption. Price tries to fall, but a large, unseen buyer is absorbing every sell order, creating a floor. The final confirmation is the character of the price action. After this period of absorption, the price should begin to drift upward, climbing the VWAP bands back towards the mean. It should do so with shallow pullbacks and a clear inability to retest the extreme lows. This entire sequence is the anatomy of an institutional accumulation cycle. The distribution signature is the mirror image. Price pushes to the upper bands. Volume swells as price churns, failing to make new highs. This is the institution feeding shares into the frenzy of breakout buyers. The subsequent price action is a sharp rejection, a failure to hold the highs, and a swift return journey back to the VWAP. This is the trap being sprung. This model is not an infallible crystal ball. No such tool exists. It is a logic engine, designed to increase the probability of aligning with institutional flow. It forces the trader to ask the right questions. Where is the price in relation to statistical value? What is the behavior of volume at this extreme? Does the subsequent price action confirm or deny the hypothesis? By abandoning the simple, flawed narrative of raw volume and adopting this multi-layered, quantitative approach, the trader moves from being the prey to the hunter. The chart is no longer a random series of bars, but a trail of footprints. The logic is clinical. The evidence is on the screen. The only variable is the discipline to follow the model. The tools for dissecting the market's logic are available. The patterns of institutional behavior, while complex, are not random. By understanding their objectives and the metrics they use, one can begin to see the hidden architecture behind the price action. The deception of volume is only effective against those who refuse to look deeper. From the Trade Logic Lab, this is the quantitative edge. To continue the dissection, subscribe for our next analysis.